Welcome to the Deep Dive. We're your source for really getting under the hood of earnings calls, delivering insights that matter, especially for you, our experienced investor audience. Today, we're slicing into the Q2 2025 results from Orion Group Holdings. They're a big name in specialty construction infrastructure. We'll break down what really drove their numbers, how the market reacted, which was interesting, and what it all means for Orion moving forward. Okay, so let's kick things off with just a snapshot of the numbers. Orion Group Holdings, they turned in a genuinely strong second quarter.
Yeah, pretty handily beat analyst expectations, both top and bottom line.
Exactly. GAAP EPS was 0.02 cents, but the adjusted number, the one folks really watch, was 0 to
Right, that strips out the one-time stuff. And that 0 to 7 significantly beat consensus.
Revenue, $205.3 million. That's up, 6.8% year over year?
Solid growth, and also topped estimates by about $7 million.
And digging in a bit, adjusted EBITDA actually doubled to $11 million.
Pushing margins up to 5.3%. That's a 240 basis point jump, 2.4 percentage points.
Which is pretty significant.
Yeah.
Gross profits soared too, up 41% year over year.
And the pipeline looks solid. Backlog at about $745.7 million as of June 30th.
Plus, they already pulled in over $450 million in new awards in the first half of the year.
So undeniably strong headline figures, right? Operational improvement, momentum. It looks good on paper.
But there's always a but, isn't there?
Well, the market reaction was cautious. A noticeable sell-off initially.
Why a disconnect?
It really suggests investors are looking past the headlines. They want deeper assurances, maybe about the sustainability of these margins. It's that classic show me attitude, you know?
Especially for what might still feel like a turnaround story.
Exactly. Is this improvement a blip, or is it the real deal going forward? That seems to be the question.
Okay, so the market's playing wait and see. Let's keep that show me vibe in mind as we unpack the overall performance and strategy. Management, CEO Travis Boone, they're talking up another strong performance, commitment to disciplined, profitable growth. They feel a real sense of momentum. That's the official line.
Right, but there's another key piece here. Alison Vasquez, the new CFO.
Just joined last month.
Yeah, and she brings a ton of experience. Finance, M&A, construction, Fortune 500 background.
So her appointment feels pretty strategic.
Definitely. It signals they're serious about navigating this next phase of growth, moving beyond just the initial turnaround. Her focus on disciplined growth in attractive expanding markets is key.
Trying to send the right message to that cautious market.
Precisely. Even if the market's saying, okay, prove it.
Right, let's break down the segments. Marine was the star, clearly. An impressive 9.4% adjusted EBITDA margin in Q2. What drove that?
Well, a couple of things really helped there. First, they had efficient project closeouts in 2025, getting work done, recognizing revenue.
Good execution.
And second, crucially, they didn't have the project delays that really hurt them back in 2024.
So smoother sailing this year, literally.
You could say that. They highlighted several good-sized projects underway. That Hawaii project at Pearl Harbor, work in the Grand Bahama shipyard.
And new wins, too.
Yep. An export dock replacement out in the Pacific Northwest. 2 projects with the Port of Tampa Bay. One's a 3-year maintenance dredging contract. The other is a critical infrastructure improvement job.
So the marine segment seems to be firing on all cylinders.
It really does.
And looking ahead for marine, opportunities still look strong?
Oh, absolutely. Robust is the word they used. You've got strong tailwinds from, several areas.
Right.
The Navy strategy in the Pacific, ongoing port expansions and maintenance, coastal rehab work, energy infrastructure. Lots of drivers.
But you mentioned a caveat earlier.
Right. A key detail for you investors. Those significant Navy awards in the Pacific, they're not really expected until mid-2026 at the earliest.
Okay. So strong outlook, but some of the really big potential wins are still a ways off.
Exactly. It's a longer-term play on that specific defense angle.
Okay, so if marine is humming along, where are the challenges? Let's pivot to the concrete business. This seems to be where some of that investor skepticism might lie. Revenue is actually up, right? 14% sequentially to $70 million.
Correct. Revenue growth was there sequentially, but the profitability, that's the issue. An adjusted EBITDA loss of $1.7 million.
Wow, compared to a $4 million profit in Q2 last year. That's a big swing. What happened?
This is definitely where the caution flags go up for the market.
Yeah.
The main reason for the drop was non-recurring stuff.
Like what?
Those favorable project closeout benefits they had in 2024, they just didn't repeat this year. One-off gains that weren't there at this time.
Okay, so a tough comparison.
A very tough comparison. Plus, they got hit hard by, quote, atrocious weather in parts of Texas and Florida.
Right, you can't control the weather. That directly impacts work on the ground.
Absolutely. Creates huge logistical headaches. But it's worth noting, if you strip out corporate overhead, the SG&A.
Selling, general, and admin costs.
Right. If you look at the standalone contribution margin for concrete, it would have been closer to 5%.
Which is more in line with what they expected.
Generally, yes. It suggests the underlying segment performance wasn't quite as bad as that headline loss figure might make it seem.
Okay, so operational challenges, tough comps. But what about demand? Especially in that hot area everyone's talking about.
Oh, demand is strong. Exceptionally strong, particularly from hyperscalers.
The big cloud guys building data centers.
Exactly. Amazon, Google, Microsoft. The whole AI race is fueling massive data center investment.
And Orion is chasing that.
Actively. They're expanding, opened a new office in Phoenix specifically for this, building on their earlier move into Florida. They're going where the growth is.
Makes sense, but strong demand usually attracts.
Competition. Yep.
Seeing more of that.
They are. They noted increased competition, new players entering the data center concrete market. It's a lucrative space.
So how does Orion compete? What's their edge?
They feel they're well positioned. They point to deep, long-standing relationships with the general contractors.
Success matters.
And a proven track record. They've done numerous complex data center projects successfully, hitting safety, quality, and schedule targets. That's their moat, essentially.
And long-term, they still see better margins for concrete.
They do. They're targeting high single-digit margins eventually, but they're realistic. It won't happen overnight.
Right. Reinforces that show me story again. We'll get there, but watch us execute.
Precisely.
Okay, so let's bring it all together. Strong marine, some challenges, but strong underlying demand in concrete, new CFO. What does this mean for the rest of 2025? Did they update guidance?
They reaffirmed their full-year guidance, which is a pretty strong signal of confidence, despite the Q2 bumps in concrete.
What are those numbers again?
Revenue between $800 million and $850 million. Adjusted EBITDA, $42 million to $46 million. Adjusted EPS, 0.10 cent to zero-lize, a 17 and 17.
Okay. And CapEx?
Between $25 million to $35 million. So, yeah, sticking to their plan shows they believe in the execution for the rest of the year.
And the opportunity pipeline, that's the forward look. How's that shaping up?
It grew significantly, expanded to about $18 billion.
Wow, up from $16 billion last quarter. That's a huge pool of potential work.
It provides a very clear line of sight to future projects, but there's that nuance again.
The delays you mentioned earlier.
Exactly. Some private sector project award decisions, including 4 pretty large ones they were tracking, got pushed from Q2 into the second half.
Why the delay?
Management chalked it up to broader economic uncertainty, worries about interest rates, stuff impacting capital decisions across the board right now.
Understandable, but feeds into that investor caution, I imagine.
No doubt.
Okay, let's zoom out a bit. Beyond Orion's specifics, what about the bigger picture? Any major tailwinds, like legislation, that could help them?
Yeah, this is where it gets interesting for the broader investment case. They highlighted 2 big things.
Go on.
First, that recently passed infrastructure bill. They called it the One Big Beautiful Bill Act, which is quite a name.
Oh, okay. What's in it for them?
It includes $4.4 billion just for shoreside infrastructure, plus benefits for their energy and industrial clients, lower operating costs, faster permits, tax benefits, makes projects more attractive.
Okay, that's significant. What's the second factor?
Last week's executive orders focused on boosting American AI dominance, specifically incentivizing new data center investments.
Directly playing into that concrete segment demand. So how do these legislative and executive actions actually help Orion convert that massive $18 billion pipeline?
Well, the expectation is they create significant tailwinds for bookings over the next few years. They should speed up project decisions, make the capital investments more financially appealing for Orion's clients.
So even though some Q2 decisions were delayed by uncertainty.
These bigger policy moves could potentially override that hesitation down the line, making the overall environment much more favorable for both marine and concrete services.
Got it. And quickly, the balance sheet, always critical in this industry.
They ended Q2 with about $31 million in net debt. Pretty modest.
Cash flow.
Operations used about $5.6 million in cash during the quarter, mostly working capital timing on big projects, paying upfront for materials, labor.
Standard timing stuff.
Seems like it. And importantly, they saw good collections and paid down some of their revolver borrowings in July. That points towards improving liquidity, good cash management. Okay, so let's tie this all back together for you, the investor. We've got strong Q2 financials, reaffirmed guidance.
But that sharp sell-off in the market initially.
Exactly. That divergence really highlights the investor skepticism. They're questioning the durability of these margins. Can concrete really recover? Can the marine margins keep compounding?
It's not enough to just show one good quarter.
Not for a stock, perhaps still viewed as a turnaround. They want to see a consistent trend, proof it's sustainable.
The show me story continues. The market needs more convincing evidence.
That's the absolute core of it right now. They need definitive proof that the concrete margin drag isn't going to be a recurring theme and that those great marine margins can be built upon.
And the stock lagging its peers, like the PAVE infrastructure ETF.
Yeah, that suggests that while management is talking momentum, the market still sees turnaround more than scaling profitable growth. They need consistent delivery to change that narrative.
So what are the key things investors should be watching for? What signals that shift?
Consistent execution is number one, especially converting that huge opportunity pipeline into actual profitable awards.
Makes sense. What else?
Stabilizing and then improving concrete margins. That's critical. Any further big award announcements, especially in marine defense or coastal funding, would also help.
The new CFO, the modest debt, those provide flexibility.
They do. Financial flexibility is there, but it really comes down to sustained project conversion and execution. That's what's needed to shift the story and maybe, just maybe, get the stock re-rated closer to its infrastructure peers. They need to prove they're accelerating, not just recovering.
All right, time for our This Is Not Financial Advice segment. Considering everything we've discussed about Orion, that show me attitude, here's a potential play for the hypothetical investment committee.
Okay, here's a thought. Could you go long ORN, the ticker, maybe with a tight stop loss just under the 50-day moving average?
That's a technical level often watched for short-term trend support.
Right. The idea is you're betting on that narrative shift from turnaround achieved to scaling profitable growth if they deliver concrete, pardon the pun, improvements in Q3, especially in that concrete segment. It's a bet on company execution.
Okay, high conviction on Orion itself. What else?
Simultaneously, maybe you hedge or look for a broader sector context. Consider a short strangle on an infrastructure ETF, like PAV.
Explain that quickly.
It's an options strategy. You sell an out-of-the-money call option and an out-of-the-money put option, both expiring maybe 2 quarters out. You profit if the ETF stays within a defined price range.
So you're betting against big moves in the broader sector.
Kind of. The rationale is the infrastructure market is generally strong, yes. But if Orion keeps lagging, or their specific catalysts don't spark an immediate re-rating, maybe the sector-wide enthusiasm is a bit stretched.
So the strangle profits if the ETF doesn't go too high or too low.
Exactly. It potentially profits from sideways movement or limited moves in the ETF, while your specific long bet on ORN is looking for that company-driven upward catalyst. It's playing specific execution against a potentially frothy sector.
Okay, let's wrap this up. In summary, Orion Group Holdings. Definitely a strong Q2 on the surface. Big improvements in revenue, EBITDA, gross profit. Marine was the standout.
Concrete had its challenges, but also showed strategic shifts in strong underlying demand, especially data centers.
And they reaffirmed their full-year guidance, pointing to that huge opportunity pipeline and favorable macro trends like infrastructure spending and AI build-out.
However, that market reaction tells a different story. Caution. Skepticism. Investors clearly want sustained proof that margins can expand consistently and that the concrete segment is firmly on the path to recovery.
Can they compound those marine margins while getting concrete back on track, profitability-wise? That seems key. So the real question left for you to think about: will Orion's operational improvements finally convince the market and lead to a re-rating? Or will investors keep waiting on the sidelines for more definitive, sustained proof of profitable growth? Thanks for tuning into the deep dive. We value your perspective. Feel free to share your thoughts on today's discussion.